So I am looking at this massive stack of sources on the desk today. Market data, agriculture reports, tech earnings, all that stuff. And reading through it as of today, August 2026, there is this really weird pattern popping up.
Right, because usually when you look at a basic economic transaction like buying groceries or filling up your car, you just assume the money flows in a straight, logical line from you to the producer.
Yeah, the basic cause and effect assumption, like you pay a higher price at the cash register, and the producer at the very start of that supply chain just takes home a proportionally larger profit.
But if you track the actual dollars in the economy right now, that straight line is basically an optical illusion. I mean, we have record high consumer prices across all these different sectors, but the original producers are absolutely not keeping the cash.
Which is wild. So our mission today is to figure out exactly where that money is getting trapped. We want to unpack the weird incentives and hidden costs driving the economy right now and just break down these financial mechanisms in a human way.
Because understanding these hidden bottlenecks is essential for you as a consumer. These aren't just quirky industry problems. They represent a fundamental shift in how value is captured or completely lost in the modern market.
A really perfect example of that friction in action is sitting right in the grocery store. So according to the data I have here, U.S. beef prices are up 12% from a year ago in supermarkets.
Which is roughly 3 times the rate of general inflation.
Exactly. So the immediate logical thought you would have is that cattle ranchers must be making an absolute killing on this surge.
Well, the ledger for a rancher like Eric Roper out in South Dakota tells a completely different story. The supply chain starts with him selling 600-pound calves for a record $2,500 each.
Wait, $2,500 for a single calf? I mean, that sounds like a massive windfall for him.
It does sound like a windfall, but that all-time high is driven by severe supply constraints. Due to extensive droughts and disease, the U.S. currently has the fewest cattle since 1951.
Okay, but even with fewer cattle, if he is getting 2,500 a head, where is the disconnect happening?
The disconnect is sitting in the hardware store and the equipment dealership. To just keep his ranch operational, Gropper is facing extreme input inflation. Like, a basic pickup truck required for the ranch is now $100,000.
Oh, wow. So it's the operational overhead just eating the price increase.
Completely eating it.
Yeah.
The wooden fence posts he needs to maintain his boundaries jump from $6 to $19 a piece, and a single roll of barbed wire doubled to $130.
So he pays taxes on what looks like a lottery win on paper, but the money is vaporizing to cover basic operations before it even hits his bank account, which means we need to follow the cash further up the chain.
Right, because if the rancher's just treading water, you have to look at the feedlots buying those record-priced calves.
But they are buying the calves at those record highs, which means their margins must remain completely flat, right?
Yeah.
The acquisition costs just consume the eventual sale price.
Exactly. So you look at the meat packers, the processors in the middle. 4 giant companies basically control 85% of the processing market.
So we have a system where consumers pay top dollar and the base suppliers make nothing. The monopolies in the middle absolutely have to be hoarding the cash.
You would think so. But Tyson Foods, the largest meat packer of them all, actually lost over $500 million on beef earlier this year.
Okay, I need you to explain that math to me. How does a dominant processor bleed $500 million when steaks have literally never been more expensive?
The math really comes down to underutilized capacity and massive fixed costs. So take a smaller operator as a microcosm to see the mechanics clearly. Harkley's Meat Packing in North Carolina, they built a processing facility designed to handle 450 cattle every single day.
But like you said earlier, the national cattle herd is at a multi-decade low. So Harpley's cannot physically acquire 450 animals no matter what they are willing to pay for them.
Right, they are only securing about 350 cattle a day. But the electric bill to keep the giant factory refrigerated, that is exactly the same. The machinery maintenance costs are the same.
And the baseline staffing payroll does not change either.
Exactly. They are spreading the exact same massive overhead expenses across 100 fewer animals every single day, which forces them into the red by anywhere from $100 to $400 on every single head of cattle they process.
So the meat packer is actually losing money, and they are trying to pass that loss onto the restaurants. But restaurants, they hit a brick wall with the consumer.
They do, because there is a ceiling on what people will pay. Take Block 16, which is this wildly popular burger spot in Omaha. They had to bump their signature burger from $8.95 up to $11.95 over the last few years.
But to actually clear a healthy profit margin and absorb the supplier costs, their internal math says they need to charge $13.
But charging $13 triggers an immediate substitution effect. The consumer just abandons the beast burger entirely, and orders a cheaper chicken sandwich instead, which destroys the restaurant's sales volume.
Listening to this dynamic, it honestly feels like an economic treadmill that someone cranked up to the max setting. The rancher, the processor, the restaurant owner, they're all sprinting and sweating just to keep from flying off the back, but nobody is actually moving forward.
And the worst part is, finance cannot speed up biology. It takes 3 years to breed a heifer, have her produce a calf, and raise that calf to slaughter weight. So the market is biologically locked into this high-friction, low-profit environment for years.
That specific mechanism you just described where the middleman is trapped by massive fixed costs and physical constraints, well, it explains another stack of reports we have today. Only this time, the middlemen are making an absolute fortune.
You are talking about the massive disconnect happening at the gas pump right now. The oil refining sector is experiencing a severe capacity shortage, kind of similar to the meat packers, but they are leveraging that bottleneck to extract a massive toll.
Because U.S. crude oil prices actually dropped roughly 10% earlier this week, hovering around $76 a barrel. But motorists pulling up to the gas station are still paying around $4.06 a gallon, which is a 36% spike since late February.
Right, and if the raw material gets cheaper, the finished product should logically get cheaper. But the space between the raw material and the finished product is governed by a metric called the crack spread.
And that is the profit margin refiners capture between the cost of crude oil coming in and the refined gasoline or diesel going out, right?
Exactly. Because global refining capacity is so tightly constrained right now, that crack spread recently surged past $70.
Which explains why Valero's second quarter profits just soared over 400% to $3.7 billion. Refineries on the U.S. Gulf Coast are running at absolute maximum capacity right now.
They are, and they are pulling in Venezuelan crude and utilizing waivers on Jones Act shipping rules just to export fuel wherever the margins are highest.
But why is the global capacity suddenly so tight? Like, what actually broke?
Well, multiple geopolitical events systematically dismantled the infrastructure. About 3 million barrels per day vanished due to ongoing disruptions in the Middle East following the escalation in February 2026.
And on top of that, Ukraine drone strikes knocked out roughly 1 million barrels per day of Russian capacity, which prompted Moscow to completely ban diesel exports just to protect their domestic supply.
Plus, China halted their fuel exports, so millions of barrels of daily capacity are simply gone from the global market.
Compounding all that physical friction, Iran and Oman are currently in the final stages of a temporary agreement to reopen a critical shipping route through the Strait of Hormuz. But the sticking point is the actual toll fee itself.
Right, Iran is demanding a 5 to 7% cargo fee for ships passing through. Oman is suggesting 3%, and the U.S. position is that there should be 0 fees.
So we have this massive bottleneck, but if refiners are making record billions off these crack spreads, I don't understand why they aren't pouring that cash into aggressively building new refineries to capture all this unmet demand.
Because energy companies view a multi-billion-dollar, multi-decade refinery project as a severe stranded asset risk. They calculate the long-term global pivot toward electric vehicles and renewable energy, and they decide it is far safer to just run their existing, fully depreciated facilities at maximum strain to collect the immediate cash.
Oh, I see. They refuse to build new infrastructure because they fear it will become obsolete before it even pays for itself. Which means this massive price disconnect between crude and the pump is basically the new normal.
It is. And this transition from physical commodities to massive digital infrastructure is really the defining financial story of August 2026. The financial reality of these physical constraints is triggering massive liquidity events today.
Wait, listening to you describe these oil refineries running at maximum capacity because the companies are terrified of the massive capital costs to build new ones, that maps perfectly onto the digital world right now.
It really does. Tech companies are facing the exact same physical constraints, but instead of crude oil, they are starved for compute. The physical servers, chips, and data centers required to run artificial intelligence.
Which brings us to today, August 6, 2026. This is a massive date for SpaceX. Following their historic $2 trillion IPO back in June, the first 20% of their employee stock lockup expires today.
Meaning roughly 911 million shares are hitting the open market for the first time.
Yeah, and we're seeing people like Andre Lavoie, a 63-year-old engineer who joined the company in 2009, sitting on 200,000 shares that are now worth about $23 million.
And he is aggressively cashing out to fund an Italian hotel and a brewery. The IPO minted an estimated 4,400 new millionaires.
But the broader market signal is why so many insiders are rushing for the exits rather than holding onto the stock, right?
Exactly. Wall Street is deeply unnerved by the company's capital expenditures, specifically regarding their massive physical AI infrastructure and their ties to XAI. SpaceX shares recently tumbled 13.6% to $108.27.
Falling well below their $135 listing price. I'm looking at the Q2 earnings report that caused that drop. Revenue nearly doubled to $7.8 billion, which sounds great.
But they spent $18.3 billion on capital expenditures. They actually recorded a net loss of $143 million for the quarter because the physical cost of building the AI architecture is astronomically high.
And the broader tech sector is feeling this exact same capital squeeze. SoftBank's latest earnings report showed a massive 1.3 trillion yen gain on Intel and significant write-ups for ByteDance.
However, they recorded zero gain on their $60 billion commitment to OpenAI.
Because the cost of compute is now so punishingly high that it is actually fracturing the talent pools at the most dominant companies on Earth. Google just lost its chief scientist, Jeff Dean, after 27 years.
They also lost all 8 original authors of the famous 2017 Transformer AI paper, and they are fleeing to startups.
And they are leaving because Google is actively rationing its tensor processing units, or TPUs. The hardware bottleneck is so severe that Google's own elite researchers are being forced to wait in line behind paying cloud computing customers just to train and test their models.
That is the friction in action.
I want to pause here for a second because this feels like a total paradigm shift. For my entire life, software has been a high-margin, low-friction business. You write the code once, and you sell it 1,000,000 times with almost zero overhead.
But listening to this AI rollout, it sounds like tech companies are functioning more like heavy utilities.
Exactly. They are laying railroad tracks or operating heavy refineries, where the physical cost of running the machine devours all the profit.
They are no longer software companies. They are heavy industrial infrastructure plays requiring billions in physical cooling, real estate, and silicon just to function.
Which is fascinating. By the way, if you are fascinated by these kinds of hidden market mechanics, you can find financial candy, brain candy, and classic audiobooks at clarineratio.com.
It is a great resource.
So we have traced this friction through billionaires' massive capital burn and computing bottlenecks. But how are these flawed digital systems hitting the everyday consumer in the real economy right now?
We can measure that friction directly in the labor market, specifically in how AI screening tools evaluate human capital and control access to employment.
Right. One of the articles in our Stack profiles, Stacy Diggood, she is 52, had a highly successful corporate career spanning decades, but recently spent 16 months sending out what she called gazillions of resumes with zero luck.
She finally resorted to Botoxing her CV, deliberately erasing her graduation dates and years of experience just to get past the automated AI screening tools.
Which highlights how the incentive structure programmed into these AI HR systems is deeply flawed. Rather than evaluating a candidate's actual capability or, their nuanced background, the algorithms often optimize for rigid, arbitrary metrics.
For example, some AI screeners are known to flag a 7-year career gap as an automatic negative, regardless of the context. This issue was highlighted in a recent lawsuit involving the software company Workday, though the company strongly denies the claims and states their AI does not consider age.
Or the algorithms penalize candidates for having too much experience, which essentially functions as automated ageism. We were sold this utopian vision that AI would act as an elite, highly objective talent scout.
But in practice, it is operating like a poorly programmed bouncer at a nightclub, aggressively keeping the best guests out simply because they don't fit a highly specific, rigid dress code.
And the economic consequences of that broken filter extend far beyond just fairness, right? It represents a massive market inefficiency. The City of London women pivoting to digital task force released data showing this AI bias could displace hundreds of thousands of women's jobs by 2035.
The financial toll for companies failing to properly evaluate and retrain this mid-career talent is staggering. The task force estimates it could cost firms over $1 billion in severance costs alone.
Because the software is supposed to streamline hiring and save money, but the friction it introduces is generating massive hidden expenses for the very companies using it.
Which brings us back to the underlying pattern across every single story today. It is all about the cost of friction.
Right. Whether we're looking at the beef industry, the oil refineries, SpaceX's massive capital burn, or these automated resume screeners.
Enormous amounts of money are flowing through these systems, but the physical bottlenecks, the massive infrastructure costs, and the flawed algorithms in the middle are eating all the actual utility.
The systems function, but the transaction costs quietly devour all the gains. The middlemen and the physical constraints are basically dictating the entire reality of the market right now.
Which raises a really structural question for the next decade of the economy. If massive physical infrastructure like data centers, power generation, and silicon is the only way to play in the AI economy, it makes you wonder if tech giants will eventually function more like sovereign nation-states.
Like, are we going to see these companies building their own private power grids and signing exclusive international resource treaties just to secure the physical capacity they need to survive?
Will the crack spread of the future be entirely digital? What happens to the pricing power of the everyday worker or small business that doesn't own any of that infrastructure?
That is a fascinating thing to consider the next time you ask a chatbot a simple question. Thank you for joining us to explore the underlying mechanics of the money world. Keep questioning the obvious narratives, and we will see you next time.